From the financial centers of the world, this is Bloomberg Markets with Alix and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, November 15th. Here are the top market stories we're following for you at this hour. Target hits the bullseye. Shares rise 17% after earnings beat estimates, helped by less markdowns and better inventory management. Was it really good or just less bad? So, is good news finally good news? You got stocks rallying, yields though push higher after a U.S. retail sales beat. We try to figure out this market as it whipsaws from panic to euphoria. And view from the C-suite. Sure, investors are optimistic. We're going to talk to CEOs. Elias Szabo, CEO of Coty, which invests in middle market retailers, and Kevin Murphy, the CEO of Ferguson, which sells everything from heating to ventilation for buildings. From New York, I'm Alix with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. You are back. Good to see you. How was Dubai? Feeling good?
Hot and busy, very busy, and you could argue kind of really positive. Certainly the vibe of the place is very positive, but the air show, oh my gosh, the positivity was there. And the airline industry does not see a recession anytime soon, Alix.
Which is so interesting because that's kind of what we're all waiting for, right? People are going to stop traveling because they're going to have to spend more to buy groceries and discretionary items, and therefore they're not going to travel. And that is not what the travel industry is seeing. Yet the numbers from TJ Maxx might paint a different story. And then you got Target. So putting it all together feels very confusing.
Yeah, I think we're in an interesting kind of transition phase. So I've been trying to think about this relating to our question of the day, which we'll get to in just a minute. We've gone from the good news is bad news, i.e. the data's too hot, so therefore the Fed's going to have to lean in on it, to the good news is good news phase. Look at Target, look at the CPI print yesterday. Small miss, big reaction, huge reaction. We've yet to get to the sort of bad news is bad news phase, which I think is what comes next. And then you get to the bad news is good news, i.e. the Fed's got to do something about this and cut. So we're in the sweet spot right now.
Do you guys get all that? All that? Good news, bad news, bad news, good. You got that? Okay, he got that.
It's just a spectrum you've got to go through, and we're working our way through it. But we're in soft landing, you could call it, everything rally, you could call it, but we've priced out. I think the critical thing about yesterday was we have priced out the good news is bad news phase. We seem to have finally moved beyond that. Nobody now believes that the Fed is going to hike anytime soon. Anytime soon. That cycle is over.
Yeah. I mean, I still think we're in confirmation bias, too, in positioning. And then you get the end of the year, so there's that part. So I don't know what the real signal is. Anyway.
I've read a lot of notes about gamma squeezes and all that kind of stuff today. That certainly, there was a positioning element to what we got yesterday. But our question of the day is a fairly straightforward one. In the middle of that spectrum, is good news finally good news? I.e., is good news no longer bad news? Denitsa Sekova and Michael McKee join us now to discuss. Denitsa, what do you think? Are we finally firmly in good news is good news territory?
I don't think we're firmly there. I think in the last few weeks, if you look at the connection and correlation between S&P and the Citi Economic Surprise Index, it's swinging between is it bad news, is it good news? And I can argue if we get too good of a, I don't know, labor report or any signs that the economy is going too hot, obviously I don't think we're going to get a good reaction to this. So I think we're in the phase of as long as things are contained and within expectations, this is going to be good news. As you said, narratives have been swifting so fast, and positioning has been helping those really big moves. Investors were so bearish at the end of October. It was positioning, it was sentiment. And now we're pricing so many rate cuts, where suddenly sentiment is spiking so many places. We see small caps rallying. So you can imagine every little disappointment in that soft landing narrative can move markets a lot.
Exactly. So, Mike, we brought you on as a skeptic, by the way, but we don't want to take that away from you. Is good news really good news?
I don't know if I'm a skeptic. I couldn't follow what Guy was saying.
Well, I mean,
no, I think
that feels normal to me. Go ahead.
What we've got here is a difference between the way the Fed looks at things and the way the markets look at things. The goal for the markets has been to try to figure out when the Fed is going to be done and when they are going to be cutting rates. And I think we've got there. Now the Fed is basically done, barring some sort of exogenous surprise. But in the run-up to this decision or this time period, every little, as Denise said, every little data point caused the markets to go one way or another. The Fed just kind of stayed on a path, and now they are probably going to look at what we have and say, we're done. I don't know that they actually say that, but everybody will accept it in the markets, and they will accept it. So then, is good news bad news or bad news good news anymore? Is it, can you base your investment decisions on what the Fed is going to do, or are you going to have a period of kind of calm where that doesn't matter anymore?
Okay, Mike, I appreciate that maybe I was a little verbose in my explanation of things, but that's a big admission from me.
It actually really is, yeah.
But to your point, we have now priced, what I think we agree on is that we've now gone past the point where good news is bad news, i.e. the data is so hot that the Fed needs to do something about it. That phase is now firmly over, which basically means that the kind of the outlook here is either we get a soft landing, which is the kind of good news phase, or we get into the good news is bad news. Sorry, the bad news is sort of good news phase, i.e., I'm getting confused now, i.e. the Fed is going to cut, and I'm kind of wondering where we are in that. And is that the next thing that happens? Is the market, it doesn't really matter what the Fed says at this point. The market has now assumed cuts, and that means that we can see risk assets rallying.
Sure. I do think we get a bit of a period of calm because everybody knows the Fed's going to be on hold for a little while. But as we get into next year, that's certainly going to be the way that the argument twists. Instead of what's it going to take for the Fed to raise rates, it'll be what's it going to take for the Fed to cut rates.
Yeah,
so
exactly.
You'll get that sort of reaction again going forward because that's what markets do.
Yeah, and like the window between the peak and the cuts gets smaller. That's going to be more volatility. Also for markets. Just taking to the news of the day, Denitsa, I feel like the Target TJX thing sets up how markets are taking the narrative, right? Target isn't as bad as we think, and it's up 17%, but sales were still down almost 5%. TJX comes in a little bit light, and it gets punished. I just wonder if this is pure confirmation bias then at the end of the day. It doesn't matter what the news is. The news is what you think it's going to be.
I think so. I think we're also at a stage where fundamentals have kind of are at the back, and they're not the most important thing driving markets. With such big moves in yields, this is still a very big driver. But if we indeed go back to that narrative of good news and bad news, if we're actually seeing signs of weakening labor markets, cooling inflation, and all this, obviously this raises the chances of a recession, of an economic slowdown, and you can start asking the question of whether a 70% upside on the S&P makes that much sense for the year.
Exactly. Do we need... this is my question that I haven't figured out yet. Do we need to see bad news in order for rates to be cut? And how does the market treat that bad news? Is it bad news and therefore we should sell risk assets, or is it bad news the Fed's going to cut, therefore we can buy risk assets? That's the bit that I think a lot of people are still trying to work their way through.
Well, I think this is something we've seen quite a few times in markets. Investors get very excited about those rate cuts, and then there is some type of realization that rate cuts comes with obviously the bad side of economic slowdown and maybe worsening fundamentals. So this may be another shift we're seeing. The thing here is we're getting from super bearish positioning to pricing a perfection soft landing. It could be earnings reports, it could be all those small fundamental things, it could be economic data, Fed speak, all those little things that can distract us from that perfect soft landing. It's very easy to go, and this is why we're here, why bearish positioning got so negative so quickly, because we came from a place where things were priced for perfection.
Mike.
Well, I insulted Guy
you did, but he was nodding
before, of course.
But to be fair, you were nodding when Guy was talking.
What you were just saying, Guy, it made me realize that what we're going to see now is going to be a little different from what we saw before, because what the market was trying to determine before was what would it take for the Fed to raise rates, and that was inflation and signs of strength. But now we've got a two-way possibility going the other direction. The Fed could cut rates because, as Denitsa was saying, the economy's bad. bad. There's a downside. They need to prop up the economy. They can also cut rates because inflation has come down. The economy is still strong, but it doesn't need the kind of restraint. So in this case, you could have good news being good news or good news being bad news, depending on which scenario you want to pick.
See? Total clarity, guys. Now we know.
got there in the end. We got there in the end, didn't we?
We got there in the end.
And everybody should feel okay and it's got to insulting me. Believe you me, the rest of the team's very comfortable with it. Mike, you shouldn't feel any different.
No, he doesn't. He's good. All right, guys, thanks a lot. We appreciate it. And also then how they cut. Anyway, all right, Denise Sakova and Mike McKee, guys, thanks a lot. We appreciate it. Coming up more on that question of the day, is good news finally good news? Sarah Hunt, partner and chief market strategist at Alpine Saxon Woods, joins us next. This is Bloomberg.
The Fed has been able to take the heat off of inflation.
Investors should be celebrating.
And essentially softer inflation prints.
Across the board, there's disinflation.
All of this points to a Fed that just does not need to be as restrictive.
The bar is high for another hike.
Really high.
I think the market reaction is a bit premature.
The Fed is not going to, take its applause and take a bow with just one data print.
They're going to stay pretty tough in holding their line against an early declaration of victory.
They don't want to declare victory yet.
They're very nervous about declaring victory and then having to undeclare victory.
They're really going to wait to see through really the first half of next year to make sure that the data continues to confirm that inflation will fall.
It will be on hold.
That period of pause has now begun.
We're going to win this thing.
Those were Bloomberg TV guests earlier weighing in on the Fed's fight against inflation. That all brings us to the question of the day. Is good news, like we see in Target, for example, in the CPI and PPI, finally good news? Joining us now, Sarah Hunt, partner and chief market strategist at Alpine Saxon Woods. You have thoughts, you told me in commercial break. Is good news finally good news?
I do have thoughts. I think as long as inflation stays somewhat on the quiet side and it looks like we're still not ticking up or doing anything bad, then good news can be good news. If inflation doesn't, however, if there's any tick up in inflation, then good news becomes bad news because good news means the economy is doing well and the Fed is going to have to keep either rates longer higher or have to hike again. So it's really going to depend to me on the path of inflation about whether or not good news can be good news, because it's signs of strength are fine as long as we don't have the inflation that's going to keep interest rates continuing to climb.
Sarah, good morning.
Morning.
In terms of how I invest, though, in these different scenarios, how big a gap is there between kind of the inflation coming down softly, the soft landing kind of narrative, the Fed can cut but do so gently, and the economy's rolling over, the recession is finally here, and as a result of which the Fed is cutting because it needs to keep the economy moving along?
I think that bifurcation is still unclear. And I think, you're seeing a reasonably good set of data in some places. You're seeing some signs of weakness in others. I looked at Capital One Financial's charge-offs today. They were higher, much higher than they were last quarter. And I think that things like that is where you're going to start to see the tension in data and whether or not you're going to be saying, okay, they're cutting because of weakness or they can cut because inflation's come down. I don't think we know the answer to that yet. And I think that that's where people are going to be watching individual things like specific company results very carefully.
In the meantime, there's some serious whippy action in any asset class. So just look at Target, up 17%, and I'm kind of like, why? I get it. It was as bad as we thought, but sales are still down 5%, right? TJX, which usually is a really good indicator for a consumer and has done really well, disappoints and it gets hit. How do we understand that?
So in those cases, for Target specifically, they've had a really hard last 12 months. And so for them, it's, I think, just the relief that the inventory problems that they're having were over, that some of the issues that they've had with margins are getting better.
That's a big relief.
Well, it's a big relief, but the stock was at 15 times, right? So compared to the rest of the group, it was really trading. It was in the penalty box. So this is coming out of the penalty box and saying, you know what, maybe things are getting a little bit better. And I'm sure that there was a lot of concern that things were going to continue to stay bad for Target, which is why the valuation was so low. go. For TJ Maxx, I mean, this is where I'm saying you start to look for individual results. They're looking at the fourth quarter, and they're not all that enthusiastic about it. They did better this quarter, but they didn't take their numbers up really for the whole year. So that's also saying we're not sure about how the holiday season is going to go. And I think that's really, as I said, the question's going to be, you know, are things really starting to finally roll over, which people have expected for, you know, ever as we've been waiting on this slowdown, or has the rolling recession gotten to the point where each sector's been hit enough and therefore we can sort of maneuver our way through this? And I don't think that we know the answer yet. I think that we're waiting on some of that, but I think that, again, it's really the path of inflation is going to matter, because if that starts to tick up again, then people are going to worry about being restrictive.
Sarah, I hear what you're saying about the sort of bottom-up approach, and you need to pick stocks, and you need to be careful, and you need to listen to what these companies are saying. The sort of the top-down narrative at the moment feels quite important, though, and we saw that yesterday. A huge rally, everything gets caught up in it, you get an everything rally. Is that going to be the story that dominates going into the end of the year? Does Santa show up this year, and does Santa show up and basically signal a big party?
Well, I think Santa was here yesterday. Whether or not he can continue to party in such a manner for the rest of the year is going to be a question. But I think really, I mean, this goes back to, are things going to slow down, or are we maneuvering through this and it's going to be okay? And I still don't think that we know the full answer to that. And so we're waiting on, you know, some of this. Wages have gotten higher, so that should be good for people to be able to spend, but that's tough on corporate margins. There's a lot of different pieces of the puzzle that are going to have to matter. And the big relief yesterday, I think, was just this idea that, you know what, we can see the end of the cycle, and therefore the market really wants the Fed to be finished. And I think that the question is going to continue to be in 2024, where do we go from here? Do we keep a higher interest rate environment like we did pre-pandemic, or do we start to go back and rates come down further and come down further? And that's the tension. I think equity markets are expecting the rates to continue to drop, and if they don't, I think that, you know, some of this relief is a little bit early.
So that just says to me that we're just going to be range bound in some capacity with some really whippy narratives and whippy price action in whatever asset class you're kind of invested in. Do you need to be trading that actively, or do you just need to like buy the dips on the stuff that you like for the next 5 years? Like, how do you manage that?
For us on the equity side, we're looking for things that we like for the next 5 years and looking for opportunities to get into those. So it's hard to chase something like yesterday because you had such a fast move. But there are areas where we think that there is opportunity. And I think that, you know, the market is a longer-term discounting mechanism, but right now what they're discounting, I have questions about what they're discounting and whether or not that's going to come to fruition. And part of that is an expectation that rates are going to go lower. And I think that if you don't get those rates to come lower in the speed that they want, we are probably going to be range-bound for a bit.
In the kind of environment we're in at the moment, where do you find the most clarity, Sarah? What is the most comprehensible right now? Is it big tech? The consumer feels really confusing. I'm desperately trying to understand what's happening with the consumer at the moment. There's lots of cross currents. But where do you see, where's the easiest bit of this market to understand?
Oh, I wish there was an easy part of this market to understand. I think that there are areas, I mean, you know, we've liked defense for a while. It had been really gotten knocked down pretty hard when a lot of when technology was rallying. There are parts of the technology space that we still like because you're going to see growth there, and the markets are going to continue to pay up for growth. So you're looking for places where you see some growth in an uncertain environment, and it's not easy. There's no place where you can say it's absolutely, you know, you can totally go and buy utilities right now. You can totally go and buy this. I think the REITs were rallying yesterday on the back of the fact that if rates are coming down, the REITs start looking more attractive again. Whether or not the commercial real estate sector is in better shape, I couldn't answer that question, and it doesn't look that great when you sit in New York and you look around. So I don't really know how that's going to play out.
Sarah, great to see you. I think we're getting towards some clarity on good news, bad news, good news, and everything else in between.
Sure.
We're working our way towards it.
Just keep telling yourself that.
Thank you very much indeed. Yeah, okay. Sarah, thank you very much indeed. The view from Sachs & Woods. OK, still ahead. SpaceX is said to be considering an IPO for its fast-growing Starlink satellite business, potentially as soon as next year. Details on this launch next. The startup is coming. Ed Ludlow's here. This is Bloomberg.
It is 23 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond, and Silicon Valley starts this morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. I don't know. It seems a little majestic when I take a look at the sunrise, kind of peeking through the clouds there. I'm trying to make a segue to your scoop on what's happening with SpaceX, looking at potentially initial public offering to Starlink. I didn't make it, but, you know, good scoop.
It was a good attempt.
Thank you.
What we've reported this morning is, my colleagues and I, according to sources, a Starlink spin-off could happen by late 2024, 2025. And off the bat, let's just be transparent with the audience. As soon as we published the story, Elon Musk had responded to a user on X, the platform formerly known as Twitter, who had taken a screen grab of that story, and all that Musk's post said was false. So, you know, he's responded to our reporting in that way. He didn't respond to our request for comments. But this kind of lines up with everything else we've heard and reported, right? Musk had said that Starlink had reached cash flow break even. That was one of the triggers he touted over the years for a possible spin-off. And I reported last week with colleagues that Starlink revenue is really dramatically ramping up. And this is the space-based internet service that everyone is just really interested in right now.
Ed, why would it want to IPO?
Yeah, I think that Starlink, in Elon's mind and in practice, is the cash cow for the entire business. There's only so much money you can make launching payload into space. So the launch side is capped in terms of sales. Starlink is growing at a click. You know, we've reported next year revenue might be 10 billion, which is the vast majority of overall revenue for SpaceX. And in the future, the vision is that this is the cash cow to fund mankind's or humankind's mission to Mars. Musk really believes that all of the money needed to do that will be generated from Starlink. A spin-off gives investors access. It helps raise capital because of all the investment to scale that business to eventually make it a super cash flow positive business.
Money versus, you know, a dream in the two different companies, basically. Ed, I hear that Elon Musk might meet Chinese President Xi Jinping today. What are they going to talk about? Like, what does Musk want to get out of this conversation?
Well, I mean, Shanghai is critically important to Tesla. It's half of its production annually, right? The Shanghai plant. You know, sources are telling us that there's this dinner with executives. We don't know who specifically is invited. We know that every tech executive that's here is trying to get in. You know, it could be supply chain related, but I think that the message overall we're hearing from sources is from the corporate America side, they just want to go back to business as normal, put the kind of geopolitics of the US-China relationship aside because of how critical an end market it is, but also the supply chain context as well.
Ed, great stuff. Thank you very much indeed. Ed Ludlow, Caroline Hyde coming up on Bloomberg Technology in around 90 minutes' time. I got to sit in an eVTOL at the Dubai Air Show, the Archer Midnight. I have to say, very cool, very excited to see that flying, firstly in the United States, then in places like the UAE. We're going to have more on what is the future of Archer eVTOL flight. Ed's had a great conversation with the company's CFO. Look forward to watching that. This is Bloomberg.
We're about an hour into his trading session. Volume strong. Equities still very much bid. Abigail Doolittle is tracking those moves for us. Abigail?
They are indeed, and it comes within a string of gains for the S&P 500 over the last 13 days. I think it's 13 days here. We do have, I'm not supposed to look that way, but I did, up 11 days, today being no exception after yesterday's big rally. So the buyers are still in business here, and it's a broad-based rally. If you look at other indexes, the Dow, the Equal Weight Index, the Russell 2000, the SOX, China Tech, all stronger, despite the fact that yields are, in fact, higher on the day. So after yields plunged yesterday on that CPI print, just a little bit cooler than expected, maybe some investors, traders rethinking that, and you can see right across the curve, we do have yields higher. It's important to watch some of the ranges here because we do have, in particular, the 2- and the 10-year yield falling right down on support. If we take a look at the 2-year yield, this is not a pretty chart, but the range is very interesting to look at, and I'm going to be very curious to see whether or not it holds. So this is going back to June. You can see it's a pretty reliable range, a very narrow sideways trend for the 2-year yield, near 5% right now, a little bit below 5%, but right on that line of support. What makes it so interesting here is the fact that the RSI is actually climbing and that it never went as low as it did when the 2-year yield was actually a little bit lower than it was yesterday on the FOMC meeting. Sometimes that kind of a divergence can be important, may suggest 2-year yields can go back up into the range and toward and above above 5%. But today, stocks digesting the fact that yields are higher and that they are where they were. One stock that is truly digesting everything in great stead here. Take a look at Target over the last 2 days, but today really up more than, I think the last time I looked, 18%, the best day since 2019. They put up massive earnings beat, better by 42%, $2.10, about $25 billion, all as inventories go lower, down 14% on a year-over-year basis, Guy. Markdowns are less. So investors really trying to catch up here into today. The stock down 26% on concerns around inventories and Target being a little bit in between, say, a higher-end department store and Walmart. But investors, again, in this stock in a big way today.
I'm confused. I continue to be confused. Trying to figure out what's happening with the consumer is a really difficult job right now. So much competing data. Let's get some more analysis. Let's figure out what's happening here. Abigail's laid out the stock reaction today. What does it really tell us about the U.S. consumer? We've got retail sales data. We've got a lot of competing numbers coming together. Elias Sabo, CEO of Coty, joins us now. Coty is a holding company. It's got a bunch of kind of middle market consumer and industrial businesses. Great person to talk to try and figure out what is happening here. Elias, nice to see you. Look, we're trying to figure out where the consumer is. Our question of the day is kind of, is good news good news? Is the consumer feeling good, and is that good news?
Yeah, thank you for having me on again, Guy. And, you know, it's we saw the retail sales data came out today, you know, pretty much kind of flattish, up a little bit, ex autos. But in general, what we've been seeing, and this has been a trend that's been happening for a year and a half, is it's a mixed bag. The consumer is, you know, stronger, the more affluent, and weaker, you know, the more price sensitive. So when we go through the mass channel, we're finding discretionary items are really under pressure. But at the highest end where we sell with our jewelry company, we're finding sales to be really robust. And it's almost linear between, you know, kind of the most price-conscious shopper to the most affluent shopper. We're seeing sort of a linear, you know, kind of correlation between strength at the top and weakness at the bottom.
So the luxury, if you have the money, you're going to spend it, and if you don't, then you're going to get crimped, which is why I'm so confused by TJ Maxx. Like, I know we're putting all the emphasis on Target, but TJ's done so well, and that's where you kind of go to get the deals. I'm speaking my book, apparently. That's where I love to shop. But, like, how does that make sense to you based on what you know of the consumer?
Yeah, and it could be some trade down, Alex, that's occurring in order to drive, and it could be merchandising. You know, there's company-specific events that can drive, you know, sales outside of what's happening in the macro economy. But I really think it just gets back to, you know, kind of what we're seeing in inflation. For the affluent consumer, inflation has much less of an impact on their real purchasing power and on discretionary purchases. And on the less affluent consumer, inflation has really eaten away at any of the discretionary purchasing power, and it's pushed them much more towards just staples. And so it is a little bit befuddling when you see some companies that are executing, you know, at different parts of the, you know, kind of price spectrum, like a TJ Maxx that's executing well. But I would credit that more to management execution rather than macro trends.
Elias, the upper-end consumer doesn't seem to be affected, as you say, by the kind of the day-to-day inflation, but the upper-end consumer is affected by what's happening in financial markets. If we get a soft landing in financial markets, if financial markets continue to perform, do you think that upper-end consumer just kind of rides through this whole process? And conversely, if the financial markets crack, how bad could it look for that upper-end consumer? How could things change?
Yeah, so, you know, my perspective, Guy, is that after going through the pandemic and having the, you know, being shut in, having our, you know, consumption of both goods and services really change dramatically, you know, consumers have a desire to spend. They have a desire to travel, spend on services, go out. You know, there's a big psychological aspect here. And so our view is that the well-heeled consumer is going to continue to spend. And irregardless of whether the stock market, you know, comes down 5 or 10% or goes up 5 or 10%, we feel that, you know, the consumer that is, you know, kind of more affluent will continue to spend. And I would also just point to the fact that we have pretty much record low unemployment right now. And so when the economy has this much employment, when wage growth is this strong, typically we don't see a recession. We continue to see strength. I mean, we are a consumer-led economy.
Yeah.
And so, for us, we look at the macro data and say, okay, under 4% unemployment, we have, kind of above trend wage growth. That inures really to the, kind of higher end consumer, we believe, and I think is going to underpin their spending even if the market starts to fall.
Elias, for the companies that you own and invest in, how are the margins when you're just outlining the fact that wages are still high, inflation's coming down, but it's still up there? How are you guys dealing with it?
Yeah, so Alex, we just put up our best margin quarter in the history of our company at 21.9% EBITDA margins. We were able to expand margins really across the board, both in our consumer and industrial businesses. And I know that statement just alone probably sounds a little, contradictory to the fact that I'm saying that at the lowest end, we're seeing some consumers be pinched in their spending. But one of the big benefits that we've seen is a real runoff of costs, from the pandemic and, the supply chain issues that we had. So commodity and input costs have really come down. Transportation costs have really come down. We're starting to see a little bit of a cresting on some of the employment costs and issues that we were having before. We had more openings over the last 18 months than we've had in the last 5 years at any time in job openings. And we're starting to see those job openings start to get filled. So a lot of the inflationary pressures that we were feeling are really coming off. We're sharing some of that with our customers, and that's, I think, why you're seeing broadly in the economy right now, inflation coming down on the CPI and the PPI level, but we're capturing a lot of that input cost reduction as well, and it's causing our margins to expand, really dramatically.
Interesting, because we always heard that, okay, well, if inflation comes down, maybe margins wind up getting hurt at some point. But Elias, good to catch up with you. Thanks so much. We'll get you back. Elias Sabo, Coty's CEO. So that was kind of the view from the C-suite when it comes to retail. Now we're going to get the view from the C-suite when it comes to industrials and more perspective on that question of the day. Is good news finally good news? Kevin Murphy is Ferguson CEO and industrial supplier. He'll be joining us next. This is Bloomberg. Equity bulls on Wall Street celebrating the latest softening in inflation from the PPI to the CPI level. So let's find out what Main Street actually thinks, which brings us to the question of the day. Is that good news? Finally, good news. Kevin Murphy is the CEO over at Ferguson. Now, Ferguson is a wholesale distributor that sells everything from ventilation to heating for buildings. And it has a non-residential and a residential section. So he's really the first in, first out when it comes to being in a building, the guts of it. Kevin, is good news really good news? Like, are you feeling the good news that Wall Street's reacting to?
Yeah, well, firstly, thank you, Alex, for having me. Thank you, Guy, for having me. Great to be with you. We do look at that as good news is good news. I mean, if I look back to, say, the fall of 2020, we saw price inflation coming through in our commodity-based products, copper tube, plastic pipe, cast iron, ductile iron. We saw it coming in fairly strong. And as expected, finished good pricing and price inflation really followed on. As we look today, that piping side of our business, the commodity side, has actually moved into deflation, and we expect broadly flat pricing for this fiscal year upcoming. And so we think that good news is good news, that inflation has subsided, and we're ready to keep moving on as an economy.
So demand holds up, but inflation comes down. That's the narrative you're discussing here, Kevin.
Yeah, demand is still a bit challenged. I mean, if you look at what's happened with what the Fed has done, like we talked about half of our business is residential, the other half non-residential, about 60% repair, replace, remodel, 40% new construction. That new construction side has been pressured. But we've got math on our side. We need about 4 million additional units of residential housing in order to get back to equilibrium. And that's about 1.5 million starts a year. Today, we're kind of bouncing around that 1.4 million level, which is not a bad place to be.
So, Kevin, we talk about this a lot when it comes to, say, companies like Siemens Energy that's involved in the energy transition or even chips. You're in a structural shift in the market, right, to say AI or to say to an energy transition. But cyclically, it's still really tough right now. Where are you in this sort of journey?
And so, like I said, about half of our business is in the non-residential space. And there's a little bit of pressure on that knock-on commercial activity that happens after residential, like strip centers and office and retail. But what we're also seeing is a very large portion of large non-residential activity in the planning and construction phase. Sustainable projects like electric vehicles, battery and storage, onshoring and reshoring of manufacturing activity, and the much needed infrastructure side. And so not only is that good for our company over the time, but it's also very good for our country. And it's more than I've seen in my career of more than 30 years inside this business.
Kevin, are you therefore changing the mix? Like, it looks like the office side of the business, that kind of area of commercial real estate is under significant pressure. But as you say, you've got the IRA kicking in, you've got the CHIPS Act kicking in, you've got a reshoring story that is coming through. How are you adapting that business, your business, to the kind of reality of what you've just discussed?
The great news about our company and about our customers is that non-residential customer can shift what they do based on what green shoots are out there in the economy. And so that contractor that may have been doing commercial mechanical work on a retail or office complex is also shifting towards things like data centers and the onshoring activity that we're talking about. And so they move their business, we move our business. We still think roughly a half and half. Residential, non-residential space serves us well, but we'll kind of follow the market in terms of where those green shoots are.
Kevin, kind of same question, but location-wise. I know you're focusing more out of Europe and into Canada and the U.S., and I'm wondering why. What's Europe doing wrong? I mean, it's a leading question, but why is the opportunity not there?
Yeah, we divested all of our European assets, all of our UK assets over the course of the last several years, and really looked at the attractiveness of the North American market. And so all of our operations today are across 1,700 plus locations in the US and Canada. And when we look at our market, everything from underground water, wastewater, stormwater infrastructure, up through plumbing, HVAC, appliances, lighting, and fire protection. The markets that are in America and in North America are very healthy, roughly a $340 billion market for us to go after, and we're only a $30 billion revenue organization today.
Kevin, do you think, though, there is a danger, and this is often discussed in financial markets, that the US government is spending too aggressively? And the kind of demand that you're seeing at the moment, therefore, is not sustainable?
Yeah, I certainly worry about what's happening with the fiscal house and how we have debt levels in the U.S. But when I look at the investment that we're making, the infrastructure investment we are making is badly needed. The roughly 4,000 plus or minus municipalities and water authorities need to rebuild that crumbling water and wastewater infrastructure. Additionally, when we look at supply chains, especially as we look back amongst the chaos that was supply chain over the last several years, bringing manufacturing activity back to the U.S., especially in areas like chips, is really important to us as a country, us as an economy, and certainly will benefit us as a company.
So let's just say, let's game it out. So say all of a sudden orders come in, economy picks up, everything's great. Is that inflationary? Do you have the stuff to supply the things for your non-residential business?
Yeah, we think that after the supply chain chaos that we have been through, the inputs to that inflationary activity, the raw materials like resin and steel and what have you, still allow us to keep pricing at a relatively flat pace. And we're still fighting through some issues as it relates to, again, new residential construction. We're down off those highs, and we still need to build back to a 1.5 million start level in order to get to equilibrium in this country.
Kevin, the president is going to meet President Xi of China a little bit later on today. You talk about the reshoring that is happening. Is that a process that you think is now inevitable? Do you think that there needs to be an improvement in relations with China? How important is China in terms of your supply chains at the moment?
So if I look at our supply chains inside of our own brand activity, for example, and where we're direct sourcing across, call it 31 different countries, we've moved a fairly substantial amount away from China, but it's broadly based across Asia, Europe, and the United States. And so for us, we've got a fairly diversified supply chain, and we feel good about the availability of that supply as we move forward. We'd certainly love to see a much more stable environment as you look forward from a supply chain perspective, but we feel pretty good about that diversification.
Kevin, great to catch up. Really appreciate the input into the program today. Thank you very much indeed for joining us. Kevin Murphy of Ferguson. Coming up, it's the end of an era for Michael Hintz. Manulife is buying CQS, the UK credit platform founded by the billionaire. Details to follow. Wall Street Beat next. This is Bloomberg.
Time now for Wall Street Beat, where we take a look at what's buzzing on Wall Street in the world of banking and finance. And there's a lot. So today we're going to start looking at Manulife's purchase of Michael Hintz's CQS credit platform. Lots of stuff happening in this space. Bloomberg Sonali Basak joins us from Florida. Hey, Sonali, what did you make of this?
I think it's really interesting to see so many of these credit platforms in particular starting to seek sales. So CQS in particular hit a bit of a road bump, especially in 2020. And it's only about $13.5 billion in assets under management, where Manulife, this investment manager, has about $613 billion or so under management. And so it's not a massive scale play. What it does is give more specialized credit expertise, which is so highly in demand right now. And you see this happening in many different areas of credit throughout the market. For example, you think TPG, Angelo Gordon. You think about the way that Antares is trying to find another firm to buy. And this is in the same vein of that. But CQS in particular, of course, has a big history going back to Sir Michael Hintz, going back to the late 1990s, used to have backing from Credit Suisse, then sold that back. And so really one of the longer standing asset managers in the credit space, and gives a different set of expertises from kind of liquid credit to regulatory capital to the idea here of also investing in mortgage markets in a broader way now to Manulife.
What does Hintz do next? What would be the most likely thing that he does? Is it just a continuation of a theme, or is it something different?
Oh, that's a good question. I don't know how he continues on here. I mean, the CQS in particular is run by Soraya Chabarek, who has been running it for a number of years now. And so she seems to be maintaining her space at CQS. But for Michael Hintz himself, that's a good question. I don't know what he's up to next.
No, fair enough. And I feel like we're getting a lot of this reshuffling in different areas, particularly in asset management, too. Sonali, we also have been getting 13Fs. What have stood out to you? I appreciate they're backward looking, but the trends are always interesting.
Yeah, there are a few things that were going on. If you look at the entire investment universe, you actually saw most of the fund management industry as net sellers of the technology world. So you think about that paired with, for example, Michael Burry's kind of end of his bearish wager. You see two things at the same time, which is a nervousness about the direction of travel moving forward. You think about what Universa said recently about the idea of the market whipping higher before it were to fall, and also this idea of taking profits. Stan Druckenmiller, for example, with his Duquesne family office, trimming his NVIDIA stake when he said he could see himself owning it for a couple of years. This is a stock that has soared more than 200%, almost 240% this year. So seeing fund managers start to take profits here while diverging on their approach to technology has been the trend we're seeing so far.
Is there, for the rest of us, Sonali, is there a useful kind of takeaway from what is happening here? Does that imply that this trend is over? What does their divergence tell us about how confused this market is right now? I'm just kind of wondering what the big picture takeaway is.
And yeah, the point too is, you see this kind of idea that 13Fs really capture the end of a period. But what have we seen since the end of the period? We have seen this kind of greater confidence in the idea that the Fed is able to take their foot off the pedal, potentially even cut into next year. But what is unanswered is how does the market behave throughout that trajectory? Even at this conference, for example, I'm sitting here still at the Citadel Global Macro Conference. There's a sense that maybe the Fed can get away with not causing a deeper downturn. But you heard Ken Griffin himself say just yesterday that the job cuts could be steeper than expected. So you do have two camps here, and that uncertainty as to why the Fed might cut makes a big difference to how the market would perform.
Great stuff, Sonali. Fantastic conference to go to. Fantastic coverage of it. Thank you very much indeed. Bloomberg Sonali Basak with the Wall Street Beat from Florida. Coming into the end of the day here in Europe, Stock 600 is up. There's still a little bit of a kind of reaction to yesterday on Wall Street into Europe. Some interesting stock stories as well. Euro dollar fairly flat. Obviously, the dollar's been coming off the boil a little bit, pushing the pound up and the euro up. That's now reversing a little bit. What is interesting out of the UK today, inflation comes down quite sharply, cementing bets that the Fed is, the Bank of England is going to cut. We get a very strong auction, but look at what the market is doing. We need to figure out what is happening here and try and get an idea of what is going on. We'll do all of that in the European close. That is coming up next.